Hello, this is Mike Swanson of WallStreetWindow.com. I've got a very special guest with me today. I'm speaking with Jordon Roy-Byrne and webs the website thedailygold.com. How you doing today, Jordan?
I'm great, Mike. Thanks for having me on.
Well, you did an interesting article a few weeks ago I'm going to refer to in a second, ask you about the history of other bear markets and price comparisons to what we saw gold do over the past couple of years to give us an idea of what could be ahead of us. Before I got to tell you, the people that I have on my email list that are listening to this, most people I kind of lost complete interest in gold. There was two things going on. First, there's a focus now in the financial markets among traders and participants that all that matters is price. That's it, is price. And that's because the stock market valuations are so high. We've been trained over the past couple of years to see that the stocks that go up the most, that are talked about, say on CNBC, on Fast Money, are stocks like Tesla that have no earnings, they make no money, they lose money, tons of, and they have all these kind of problems. So earnings and valuations really don't make any difference in what goes up. And I think that kind of mentality has been on display with Bitcoin this year, which has exploded, and all that matters with that is the pure price action is what's captivating people. And they're not buying Bitcoin because they're going to get a dividend, or Tesla because they're going to get a dividend, or because they think the earnings are going to grow, or anything like that. So I say that to talk about gold, where there's been a collapse, I would say, in interest in gold, the least amount of interest I've probably ever seen in it. Last year, when it went up, there was some interest in the summer, and even in the bear market, there's interest because it's crashing and there's movement. But now the GDX has been trading basically between 21 and 25 or so all year, and gold's not really moved much. So no one cares about it. No one's interested in it. They want other things, and I think it's going to really take higher price action. I got an investment position in gold. I think it's an important thing to have in a portfolio. In the mining stocks, I'm getting dividends from them, and I like owning them. I don't have 100% of my account in or anything, but I got core positions as investments in this stuff that I think is going to pay off in the next couple of years. But no one cares. I mean, and until gold goes up and the GDX goes up to a certain level, I don't think anyone's going to care. So I don't know if you see things that way too, or how high does it have to go before people do care?
Well, looking at GDX, it probably has to break above, I think, about 25.5, because if you look at the price action over the last 12 months or so, there's clear resistance around 25.5. After we corrected hard in the second half of last year, and then when we rallied at the beginning of this year, we got up to about 25.5, and then we consolidated for several months, and then the late summer rally, which peaked in September, we got up to about 25.5, the same level. So really, if we get a weekly or a monthly close above 25.5, that is going to bring GDX much closer to testing 31.32, which is the 2016 high. And if you go back 5 or 6 years and you look at any gold stock chart, even the chart of gold, if we get above those 2016 highs, the market is really going to be at the start of a strong move fueled by momentum, fueled by increasing momentum technically, but obviously the fundamentals have to be in place for getting that kind of move. And as we talked beforehand, I don't see the fundamentals as being in place right now. But I do think, based on some things that I'm looking at fundamentally, I'm looking for that to change sometime next year, and that matches up with the history that I believe we're going to talk about.
Okay, well, I'll flip. I'm going to people are going to ask me, so I'm just going to preempt the questions that I had no idea. When I think you're right. I think the 25 level on GDX, or 25.5, is the critical level. It's got to get above that before people really get interested. Perhaps 24 could be the level that will just get you right to that higher level real fast. But either way, it has to go up before people are going to care. But my charts, just the chart itself, the volatility is so low. It could just happen overnight. at any moment, So I don't know if it's going to happen next month or next year or 3 months from now or 6 months from now. And that's why I just hold my position. I'm afraid if I get out, I'll miss it. So I just hold it. But that said, people want, some sort of more specific defined prediction. I don't have the ability to give them that. But you got historical charts here that, people can come to an idea off of that. So I'm going to flip to that real quick and just let people can read it on your website too, thedailygold.com. But I'm flipping to it right now, and you got these old bear markets here. Real interesting stuff.
Yeah, and Mike, I'll just add that, you can't predict the future. I can't predict the future either. But what we can do is look at these things and assess probabilities. I mean, as you and I know, there's a lot of people in the gold analyst community. Well, not a lot of people, but there's some people who, they make these calls and they kind of claim to be able to predict the future and predict what's coming. You and I, we're smart enough to know that we can't know that. It's impossible. But what we can do is look at history, look at the data, and kind of assess, okay, what are the probabilities going forward? What are the things that we could rule out, like these people saying, if gold's going to go to 2,000 in 1 year, or 10,000, or gold's going to go to 500? I mean, we can rule that out. I mean, those are just extreme predictions that really have no basis.
Well, we've seen, of course, Jim Rickards has a 10,000 gold target, but we have seen, what's his name, Harvey Dent call for these crashes that never materialize. In fact, there's a headline article in Kitco saying Harvey Dent's predictions have been demolished, and they have. But then there's the guy, what's his face, that's got Socrates and all that crap. But, but anyway, I'll just shut up and let you talk.
Well, I apologize because I kind of went off on a tangent. But my point is, we try and look at the data to assess probabilities because we can't, nobody can predict the future. I mean, nobody knows what's coming. But with respect to the gold stocks, Mike, I mean, and this is something I started to discover earlier this year when I noticed that the gold stocks look similar to the housing market as far as the recovery after the housing market bottomed in 2009. And then there was an analyst, I think his name is James Flanagan from Gann Global Financial, and he really does some fantastic historical work. I mean, he really looks at historical market moves in every market just over decades, not just like 5 or 10 years. And so he was talking about the gold stocks following a historical pattern. So I kind of thought back to my housing comparison, and I thought to myself, well, this is very interesting. Let's see how gold stock, that was a mega bear market. Let's see how other mega bear markets have performed after the bear market, after they bottomed. And I'm looking at markets that were really down at least close to 3 years and down over 80%, and then what happened after the eventual bottom.
Oh, okay, because that's what the gold stocks did, yeah.
Yeah, exactly, and I noticed that there's 3 really good comparisons to the gold stocks, and those are the S&P 500 after the Great Depression, the housing market after its 2009 bottom, and then the Thailand in the late 1990s after, the Asian financial crisis there. And, I know we're going to show some of the data in the video, but looking at, the S&P 500 from 29 to 32, it was down almost 3 years, down 87%. Housing, 2005 to 2009 was down 3 years, 8 months, 81%. Thailand was down 4 years, 8 months, and 88%. The gold stocks, depending on, the data I have is of the Huey Gold Bugs Index, and that index was down 84% over 4 years and 4 months. But the thing is, these 3 comparisons, then they rebounded 177%, 137%, 165%. The Huey rebounded 180%. But those 3 other markets, they then essentially corrected and consolidated for over a year. And if you look at the S&P 500 in housing, they corrected 34% for a year and 8 months. Housing was 42% for a year and 6 months. Thailand corrected about 54% for a year and 4 months, but then Thailand rallied and then kind of consolidated for another year before it went much, much higher. And so back to the S&P 500 in housing, their correction and consolidation after that initial rebound was a year and 6 months and a year and 8 months. Now the gold stocks are about a year and 3 months or a year and 4 months into their correction. But what happened in those other markets is after that correction, they began a next leg higher, which was a real impulsive advance. It wasn't like, well, we're going to rally a little bit and then come back, go sideways. It was no, they went straight up and they kept going up. I mean, after that correction, the S&P 500 went up 132% in 2 years. I mean, that's a huge move for the U.S. stock market, even though it was obviously much smaller back then. But housing went up 177% over about 18 months. Thailand then, after its long and sharp correction, went up 200% over the next 2 years and 2 months. And you can even, Mike, look at some other markets that follow the same pattern I have on that spreadsheet. The same thing happened with banks in Ireland. They were both down over 80%. Those bear markets were only about plus 2 years. They weren't quite as long, but they followed a very similar pattern where you have this sharp rebound and then you correct and consolidate for quite a while before leading to the next leg higher. And, just a couple other examples, things I was looking at. The mortgage market followed this pattern. The solar stocks followed this pattern. And I mean, everything, the moves are not all identical. Some of these markets, their initial rebound was much stronger than others. Some corrected, a little bit longer than others. And then, but they all follow this pattern, Mike, where if you're thinking about Elliott wave analysis, they had a really quick wave one move up, and then they had a really long wave two correction, and it consolidated for a while, and then that eventually led to a sharp move higher, wave three. They all did that. And so getting back to the gold stocks, based on this data, I'm kind of, based on historical data, the question is, okay, when are the gold stocks going, when in time are they going to begin that next sharp move higher? Obviously, like we said, we can't predict the future. We don't know. But based on these historical patterns, the probability of it happening is very strong. And, looking at the timing, I'm kind of thinking, we could see this begin anywhere from 3 months to 9 months. But it's just, Mike, we're going to have to follow other things to get a better idea. Like I said, it could be 3 months, it could be 9 months, maybe it's 10 months, maybe it's 7 months. We don't know, but just from looking at this data,
is it possible that it could actually? I think it could start before the end of the year. Maybe I could be wrong, of course, but seasonally, the past couple of years, gold has rallied. Starting at the end of the year, and we got the December Fed meeting, and that might be the last rate hike, or it could be we get one more. But you were talking about the fundamental picture needs to change, but it could change next year, and the gold starts to move before it changes. It's just tough. It's tough to know for sure. Yeah,
I agree with you. It will. The fundamental picture will change leading up to when this really big move happens, or I should actually, the big move will start to happen as before the fundamental picture is changing. But again, just looking at the historical pattern. And we know that looking at gold and gold stocks, Mike, they have clear resistance, but they have a big base going back about 5 years. And so, like we were talking about at the beginning, once they get over these levels and the fundamentals are more bullish, you're going to bring in a lot more buyers because, as you said, Mike, nobody cares about gold right now. Gold and gold stocks have just been correcting, consolidating for over a year, and people don't care, so people are out of the market. But when fundamentals turn bullish and we look at the technicals and we look at what happens when they can get above these levels and the fundamentals stay bullish, you're going to get a very strong move higher. You're going to get strong momentum. That's going to feed on itself, and it's going to, the market's going to continue to rise. Momentum's going to get much, much stronger. It'll rise even more. And again, just looking at the history here, mega bear markets follow this pattern after they bottom, and gold stocks are following the pattern to a T. What happened to these other bear markets after they bottomed, and it's just, it's very optimistic for the gold stocks over the next couple of years. But again, it's just a question of, when is this next move going to be? Like I said, we don't know. It could happen, and it could start in a month or two, or it could be not, it could be 9 months from now. We just don't know. Yeah. But it's important to look at this and just get an idea of there's no certainty, but just the probability. When we look at everything, there's a probability that this sector is going to begin a big move higher, at some point inside of the next year. Could be a couple months, could be longer than that, but the probability says we're setting up for, probably a really big move high. I mean, me personally, I'm kind of thinking the big move will start maybe around Q2 or Q3 of next year, and I mean, that would set us up for very strong second half of next year and then a really strong 2019. So that's kind of how I see things right now, Mike.
Yeah, and it's important too to keep abreast of the historic comparisons as you're giving, because it does give you a good guidepost to the future. How things can unfold when they start to, and everyone's asleep. I mean, they're not paying attention to this at all. They just aren't. They're watching. They're not going to talk about what you're talking about here tonight on CNBC. They're probably going to mention Bitcoin, even though they don't like Bitcoin either, but they've got to mention it because it's everywhere today. It's all the headlines this morning are Bitcoin, 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 because it made an all-time new high. I didn't see a single headline about gold. I didn't get a single email about gold today. No one cares, but these historical comparisons are what keep you on track, and you got to keep your eye on this. People got to keep their eye on what you're showing in this article.
Yeah, absolutely. And speaking of historical comparisons, I mean, I don't know a lot about Bitcoin. I haven't followed it. Unfortunately, haven't invested in it. But historical comparisons, you can just look at the chart of Bitcoin and compare that to other charts of market bubbles. That, I mean, we don't know when it's going to happen, but Mike, you and I, we've been in the markets long enough to know that at some point this cryptocurrency thing is going to crash. Now, maybe it'll go much higher 5 or 10 years from now, I don't know, but just with the way they've traded in recent years, these are parabolic moves. It's getting really dangerous. They're going to crash at some point.
Well, that could be part of a catalyst that does get people into gold stocks, because some of the people buying that are thinking it's like gold, basically, and it's an they think it's an alternative currency and all this kind of stuff. So if that crashes, those kind of people might gravitate to gold stocks.
Yeah, I mean, that's possible. I mean, because when one market or asset crashes, you see other markets or assets start to benefit or start to take the leadership baton. I mean, it happens throughout history. I mean, when tech stocks crashed in the late 90s, we had a hard assets bull market after that. When hard assets and commodities really broke down at the end of 2012 and early 2013, I mean, that benefited U.S. stocks as they broke to new all-time highs, and they've run for several years here. So, yeah, the cryptocurrency space, I mean, a crash there would definitely benefit, or at least you'd see another market start to outperform.
Yeah, it's interesting. We're going into December. But, one last thought I'd like to throw at you about the gold stuff is that one positive about it, is that the last month there was a day in which gold was down $20. I don't remember what the cause of that was, but there was a day where gold, it fell, $20, I think $10 the day before after that too, and the gold stocks barely dropped at all. And that tells me that we're not in some sort of bear market environment or something, because if we were, we would have seen the gold stocks collapse, be down 5 or 10% when that happened. That's what was going on from 2011 to 2016 when they bottomed, and they didn't do that. And that's, we're still in this sideways consolidation, but it tells me that it is not a bear market consolidation, or else by now the stocks would be crashing and rolling over and, and so forth.
Yeah, I mean, that's a great point. I mean, I've kind of been wrong, because every time they correct, I tend to get overly cautious and bearish, and I think, okay, well, they're going to drop down to this strong support, but, that doesn't always happen. And we've been, we had the nasty bear market, and now we've been correcting and digesting that move since the peak, over a year ago. And I mean, prior to that move, we had this mega bear market, the worst bear market ever, which led to gold stocks and being at, in relative terms compared to gold stocks and things like that. I mean, they were at like 80 or 90-year lows. So the point I'm getting at here, Mike, is there's not a lot of sellers left in this market. And the fact that gold stocks have consolidated for most of 2017, and like you're saying, I mean, you noticed a day when gold made a big move down, but the gold stocks didn't really follow. I mean, that to me just tells us that there's not many sellers left to push this market that much lower.
Yeah,
we're just, like we said at the beginning, once the fundamentals come into place, we start to get better price action and momentum, then things will really take off for precious metals. But here and now, there's just, the buyers aren't there, but there's not a whole lot of sellers left either.
Right, yeah, so it's in this situation where the price has to move up to get the buyers in. So we're kind of waiting for that to happen. It's just how long is it going to take, I guess. That's the question. But, well, as we wrap up, could you tell people where to go to get more information from you?
Sure, they can go to dailygold.com. They can find out more about my premium newsletter there. They should also, if they haven't already, they can opt in for my free newsletter where once a week I send out some snippets of the premium work that I have published, and I share all my free work in that newsletter.
Okay, great. Well, I recommend people do that too. I'm looking at your stuff and keeping abreast of everything. And thanks for taking the time to talk to me and everyone else.
Thanks so much for having me, Mike. My pleasure.